Welcome to our episode of Financial Lens titled Diversification. If you know much about me as a financial planner, you'll know that I am not fond of jargon and buzzwords in the financial circles because I find that a lot of times people don't really know what those words mean, and diversification is really a classic example for me. I talk to many folks who will tell me, I have a diversified portfolio, and I would suspect that a lot of times people don't really know what that means. And what people generally think a diversified portfolio means is that they have a lot of different stuff. And because they have a lot of different stuff, that's what makes it diversified. But that's really not the technical understanding of diversification. The technical definition of diversification is when something goes up, when an economic condition causes something to go up, it causes something else to go down. So diversification is this kind of an effect in a portfolio where you're having certain market events that cause something to go up and at the same time cause something else to go down. So in a portfolio that's diversified, you're always going to have parts of your portfolio that you like and parts of your portfolio that you don't like. Some of it will be going up and some of it will be going down at the same time. So let's talk about diversification, how it might work in a sort of an example, and we'll take that into the practical view of stocks and bonds. So let's assume that you own an apartment building, and you own a very large apartment building in a city block, and your apartment building fills up that whole city block. And someone will say to you, it's not really good to have this big, large real estate holding, because what happens if there's a fire and the whole city block goes up in flames? You're going to lose your entire apartment complex. So, you don't want to do that. And, what also if you have that part of the city kind of go bad and a lot of crime comes into that part of the city, your apartment complex is going to be very negatively impacted by that. So what you should do, you should sell off your large apartment building and buy smaller apartments throughout the city. Well, that makes sense. You're diversifying. You're buying different properties throughout the city. And let's assume that this is Katrina and you have apartments in New Orleans. You have apartments throughout the entire city. When Katrina hit, the entire city was underwater. And so when that flood hit, it didn't really matter which part of the city your apartment was located. The entire city was underwater. And so what happened is that you did not diversify outside the zone of risk. And that zone of risk is a flood. So why is that relevant? Because when we look at diversified portfolios, a lot of times people look at stocks and bonds as diversified portfolios. And they figure when stocks go up, the value of bonds go down, and vice versa. When bonds go up, the value of stocks goes. When a value of bonds goes up, the value of stocks goes down. So you have this inverse relationship with stocks and bonds. However, that doesn't happen, or that doesn't continue to be true. It doesn't continue to occur when the interest rates go up, when the Federal Reserve causes interest rates to go up. Because when interest rates go up, that causes stocks and bonds to both go down. It causes stocks to go down because as interest rates are higher, it costs more money for corporations to invest, to borrow money, to build operations. It's harder for consumers to borrow money to purchase products. And when interest rates go up, the value of the bonds goes down. So when you have an environment where interest rates go up, stocks and bonds that sometimes are diversified are not in that situation. So what's important to do, it's important to look at portfolios that have more diversification with other vehicles so that if you have an interest rate increase, diversification from stocks and bonds do not both go away. A couple strategies are reinsurance. Reinsurance is a strategy where you have companies that take on risk. And what they do is they sell off some of that risk so that if there's a catastrophic loss, the company doesn't go bankrupt. What might that mean? That might be something like if you have property and casualty insurance companies that insure homes, and they have, let's say, quite a few properties that they're insuring by a shore. Well, they may feel that if there's a hurricane, they're going to get wiped out. So they may sell off some of that risk. That's called reinsurance. There's other strategies that work as well. There's something called a trend following strategy. With a trend following strategy, what happens is there's investments done in such a way that when markets are moving in a certain direction, there's a certain way to invest in that kind of a strategy, and that when the markets go from being strong to very strong or being weak to very weak, that is a particularly good opportunity for that trend following strategy. Another strategy is real estate or real property or real assets, such things as land, timber, farmland. These have a slightly positive correlation between stocks, but they provide some additional diversification that still holds when we have interest rates go up or down. So when you look at your portfolio, don't be thinking about having a lot of different stuff. Look at having different parts of your portfolio have investments in it that behave in such a way that when one goes up, the other one goes down in different economic cycles. Thank you for listening to the Financial Lens episode. We're hoping that you'll listen to our future episodes, and it's our privilege to be of service to you. Thanks for listening.